What happens when the world's most peaceful border becomes an economic battleground overnight? What if a simple tariff hike suddenly turns shipping containers into weapons of trade and sparks a crisis that could shatter a 40-year-old North American alliance? This isn't fiction, it's unfolding now. And the stakes? Nothing less than the future of the global supply chain. If you're watching from Detroit, Toronto, Dallas, or Vancouver, your job, your business, even your groceries might soon feel the shockwaves of this escalating metal war. Why is Canada turning away American goods at its ports? Why are US factories scrambling to find steel? And what exactly happens on July 16th, a date markets are calling the Day of Reckoning? Stay with us to find out. Just 5 months into Donald Trump's second term, the North American Trade Foundation is cracking under the weight of a dramatic and unilateral US decision. In late March, President Trump signed an executive order doubling tariffs on imported steel and aluminum, from 25% to a shocking 50%. This wasn't just a jab at China or Russia. This time, Canada and Mexico, America's closest allies and trading partners, were directly in the crosshairs. Strong trade means a strong military. Weak steel is no different from weak borders, Trump declared, sending shockwaves through Congress and across trading floors around the world. Within hours, the dollar index spiked, metal futures in Chicago went wild, and procurement departments across the US and Canada were forced into emergency mode. Suddenly, the free flow of steel and aluminum, the lifeblood of countless industries, was under siege. Canada didn't wait long to respond. Within 24 hours, Prime Minister Mark Carney stood before Parliament and used a term no Canadian leader had used before: a single Canadian economy. It was a rhetorical missile, signaling a break from decades of North American integration. Carney's message was clear: Canada would act swiftly, firmly, and in its own national interest. And act it did. The next morning, Ottawa announced automatic retaliatory tariffs on American steel and aluminum, starting at 25% and escalating in stages from July 21st. But the twist: these tariffs weren't fixed. Canada's new system would adjust rates automatically, in real time, based on the progress, or failure, of negotiations with the US. This innovation, tied to Canada's Customs Tariff Act emergency provision, created a dynamic pressure tool unseen since 1990. Then came the strategic filters. First, a Buy Canadian policy for federally funded infrastructure projects. From naval shipbuilding to high-speed rail, all government projects now require Canadian melted and cast metals. American suppliers won't just face tariffs. They'll lose their equal footing in contract bids unless they manufacture within Canada's borders. Second, Ottawa rolled out a new origin-based quota system. Not only will quotas apply retroactively to January 1, 2025, but goods currently docked at Canadian ports, yet to clear customs, are already being turned away. The Port of Vancouver is rerouting containers. Detroit's factories are going into panic mode. And the global supply chain. It's holding its breath. But this isn't just about trade penalties. Canada's broader strategy is calculated, coordinated, and backed by serious cash. Under a new $10 billion initiative called the Business Emergency Tariff Credit Option, BETCO for short, Canada is extending low-interest financing to domestic manufacturers hurt by the tariffs. Companies can apply for up to $50 million each, but there's a catch: they must submit a supply chain relocation plan. In other words, move your sourcing inside Canada, or near it, or risk being cut off. Meanwhile, 5 sectoral action tables: steel, aluminum, automotive, machinery, and infrastructure, are feeding Ottawa weekly data on price shifts, export flows, and capacity rates. This isn't a one-time retaliation. It's a new permanent apparatus, designed to manage critical industrial supplies with precision. And it echoes the pandemic-era emergency supply frameworks, except this time, the battlefield is heavy industry, not healthcare. So how did Washington respond? Not well. The White House called Canada's move insincere and unnecessary. The U.S. Trade Representative threatened a WTO case. But even within the U.S., backlash is building. The Michigan Steel Producers Association warned of disaster for the auto supply chain. Boeing and SpaceX raised alarms over their dependence on Canadian aluminum. And US auto plants still rely heavily on Ontario's high-strength steel. Trump's team hinted at possible exemptions for US manufacturers, but Canada isn't budging. Not without seeing that list. And not before July 16th. Yes, July 16th, mark that date. It's the midpoint in a tense 30-day negotiation window that began after a reportedly heated closed-door clash between Trump and Carney at the G7 summit in Alberta. Markets are pricing this like a geopolitical thriller. Option contracts for mid-July steel delivery are at record highs. Traders are sitting on inventory like it's gold, waiting for the tariff verdict. But there's more. In Canada, the opposition is fuming. Why delay retaliation until July 21st? Why not July 1st, Canada Day? Carney's government says the timeline allows coordination with global partners like Japan, the EU, and South Korea. Brussels is drafting its own steel weighting shield. Tokyo is exploring small-batch aluminum shipments to Canada. The world is picking sides. And here's the real game-changer, Canada's new melt and cast origin rule. This single regulation destroys a major loophole. US companies can no longer import cheap Chinese metal, process it in Mexico, slap on a Made in USA label, and export it to Canada. Now, the Canadian Border Services Agency requires dual traceability. Every shipment must include chemical analysis reports for each production stage. The result? A paperwork nightmare for importers, and a data goldmine for Ottawa. But there's opportunity too. Canada's Build Canada Fund, used to finance infrastructure, is now prioritizing domestic metal use. $24 billion worth of projects are being retooled. The biggest? A green hydrogen corridor stretching from the Atlantic to the prairies. Initially sourcing from Asia, it's now eyeing Ontario-made steel from 10 areas. Job postings are already up. Ontario's mills are firing back to life. Carney's message: build the strongest economy in the G7. And that means leveraging every policy lever available. Defense spending has increased to 2.8% of GDP. 1/3 of that is earmarked for buying Canadian-made metals. New Arctic patrol ships for the Royal Navy will use only Canadian steel. Even scrap metal ratios are being reduced to dodge new tariff risks. Recycling firms are booming. Green steel exports to Europe are in the pipeline. One of the most interesting wrinkles is what's being called the Bullgate Tariff Gate, Canada's limited exemption system. US suppliers can apply for exemptions on highly specialized alloys, but only with a dense 10-part application. It includes a moment of inertia technical report and proof of insufficient Canadian capacity. The bureaucratic pressure is intentional. It buys Canadian firms time to develop alternative capabilities. Case in point, a Montreal factory is now tooling up to make nickel-chromium alloy landing gear, something it has never done before. And Export Development Canada is funding the expansion. This isn't a spat. This is Canada rewriting its industrial DNA. Where once supply chains crisscrossed North America without a second thought, now every shipment is scrutinized, every contract reviewed, every ton of metal tracked. Pension funds are watching. Trade unions are rallying. Investors are hedging. And global governments are redrawing their steel playbooks. In Europe, Brussels has condemned Trump's tariffs and their exemption mechanisms as WTO violations. But the EU isn't retaliating directly yet. Instead, it's deploying a strategic market support model. In Germany, steelmakers are envious of Canada's rapid-fire response. In France, the European Investment Bank is expanding green steel bonds, hoping to mirror Canada's industrial shift without triggering a full-scale trade war. As July 16th looms, markets are on edge. Will this tariff war cool off, or explode into a lasting fracture of North American trade? The Fed is worried about inflationary spikes as metal costs skyrocket. The Bank of Canada is preparing to hedge against dollar-based debt pressure. Meanwhile, global logistics managers are redrawing their maps. Because make no mistake, steel and aluminum aren't just metals. They are the scaffolding of modern economies. They shape cities, planes, defense systems, and even election campaigns. And now, they've become geopolitical weapons in a trade war no one saw coming, but everyone is watching. So what happens next? Will the US cave to pressure and ease tariffs? Will Canada double down and harden its single Canadian economy strategy? And what if more countries follow suit, each building their own steel walls and chasing industrial self-sufficiency? One thing is certain, The metal war of 2025 is redefining borders, not with bullets, but with bolts. And while politicians negotiate in boardrooms, workers, manufacturers, and families across North America are left to wonder, can we still trust the supply chains we've spent decades building? Let us know what you think in the comments below. Is Canada making the right move? Is Trump's tariff justified? And how do you think this ends? If you found this video informative, make sure to hit that like button, subscribe to our channel, and turn on the bell icon so you don't miss our deep dives into the world's most pressing geopolitical and economic stories. Until next time, stay informed, stay curious, and watch those shipping containers.